By the year 2026, Dubai is operating with an accelerated momentum, defined by a constant state of rapid urban expansion. This chart shows that despite record-breaking transaction volumes in the first quarter, 69% of investors surveyed expect property prices to continue their upward climb. To an outside observer, this trajectory looks like a classic speculative bubble, a market detached from reality and destined for a correction. But to test that theory, we have to look past the sentiment and find the specific macroeconomic forces pulling capital into the city. You cannot analyze the price of a single Dubai apartment in isolation. You have to zoom out and look at the economic architecture of the entire region. The outer circle of that architecture is the Gulf Cooperation Council, which is increasingly operating as a unified economic bloc. Saudi Arabia is currently driving this with a new $2.3 billion injection into its Vision 2030 projects. These are long-term structural investments in tourism, infrastructure, and urban development, rather than temporary oil windfalls. Committing billions to physical infrastructure creates a long-term capital lock-in. For global investors, these projects signal a regional pivot toward economic permanence, making the area a more attractive destination for capital. As Saudi Arabia executes this transformation, the entire GCC gains momentum as a primary hub for wealth creation. This regional growth provides a significant tailwind for Dubai's property market. That regional capital is landing in a city that has spent years refining its own local economic engine. This area chart shows the result. Dubai's GDP reached 232 billion dirhams in the first quarter of 2026, representing a steady 2.4% year-on-year growth. That growth is broad-based, coming from an intentional expansion into non-oil sectors to insulate against global fluctuations. The finance sector remains a primary pillar of this strategy. It is supported by a robust retail and consumer sector, and the city continues to invest in healthcare infrastructure to support long-term population retention. This diversified 232 billion dirham economy drives consistent job creation, and those jobs are the prerequisite for sustained real estate demand. When an economy creates specialized jobs, it leads directly to an influx of new long-term residents. In June 2026, the housing market hit a visible breaking point, recording 40,022 rental contracts, a 48.6% increase over the previous year. Because landlords confidently project long-term growth, many choose to lease rather than sell, further constraining the available inventory. This creates a physical bottleneck. Even with cranes across the city, new supply struggles to keep pace with the volume of arriving residents. Rising property prices are not just the result of sentiment. They are the result of a mathematical crunch between surging demand and limited inventory. The progression is clear. Regional investment builds local GDP. Local GDP attracts populations, and those populations create a physical demand for housing. This market is the result of a multi-decade shift toward economic diversification and population growth. The 2026 price tag is the premium investors pay for a market defined by regional investment, a diversified economy, and a measurable housing shortage.